Hey guys, welcome back to a brand new video. I'm RexFinance, and today we're going to be talking about what I think is going to be a 2023 market boom. I believe the NASDAQ is going to go up 10 to 15% this year, and the S&P 500 and the Dow Jones Industrial the Dow Jones Industrial Average will also go up 6 to 10%. Now, before I get into the video, I have to apologize for the backdrop. We're kind of doing some renovations here in my recording studio. So today we have a globe behind me. Oh, and my Starlink router back there, that's new. And also just a tiny little plant. So, I just picked out some random items to go on the table today. I hope you guys are okay with it. Now, if you guys have been living under a rock, you might not know this, and I don't want to assume that nobody lives under a rock. But the stock market is up huge during the first 6.5 trading days of 2023. The NASDAQ, for example, is up 4.32%, and my personal portfolio is up more than 20% because I own some very high beta stocks, very volatile stocks. Takes a big gut. I don't have one. I'm pretty skinny. I don't know how I do it. But in all seriousness, if we really look at the grand scheme of things here, this little market rally we've had at the start of this year hasn't even put a dent in the more than 30% we've lost in the NASDAQ since highs of 2021. All right, I saw a squirrel. I also have this wooden airplane in the backdrop. If you guys missed it, it is there. It is like painted too. Might have been me when I was young, I don't know, but it's sitting back here. Now, if you want to call me a clown, at least wait till the end of the video and hear me out as to why I think the market's going to rally so much this year. If not, yeah, just go ahead and call me a clown now and click off the video. I don't really care. But for those of you that do care what I have to say, first of all, thank you. Second of all, the reason why I think the markets are going to rally so much is because the Fed is actually winning this battle against inflation. The Fed has taken so much crap from everybody. Yes, they were behind the ball when inflation first kicked off. I can't hardly talk in this video. I don't know why. But it seems like they're actually on the path here to a soft landing, which has never been accomplished in history, so the markets have doubted that the Fed could actually pull this off. If we scroll back, I know this is kind of an ugly chart, but stick with me. Inflation first started to pick up in February of 2021, where it went from 1.4 to 1.7%. Still very low, but you can see it only took a handful of months for us to reach a peak of 9.1% inflation year over year in June of 2022. Now, ever since then, we have been falling significantly. The rate at which inflation is falling is actually exceeding the rate at which it increased over time, which is a really, really good thing to see. In just 5 or 6 months, we've gone from 9.1% inflation down to 7.1%, and this snowball effect is likely going to continue, where each month that goes by, the inflation rate goes down more and more. Kind of an exponential curve, I guess you could say, for you scholars out there. And tomorrow, if you're really keen to the financial markets, we actually get new CPI data, if you didn't already know. Now, get your pens and pencils and notepads and whatever out, because I'm going to tell you what the markets are expecting. Tomorrow, the markets are expecting the CPI inflation data to show 6.6% inflation year over year for the month of December. That would be a significant drop from the most recent data we got of 7.1%. If we meet the 6.6% or even beat the 6.6%, meaning we actually get a number of 6.5 or 6.4%, the markets are very likely to rally another 2 to 3%, even though we've already started out 2023 extremely hot. In fact, if we do drop below 7% inflation year over year, that will be the first time we are below 7% since November of 2021. Does anybody watching remember November of 2021? We all had multiple Lamborghinis. We were wearing iced out chains and watches. I really wasn't, but we saw it all over social media. Again, I can't talk in this video. I'm sorry. I don't know why. But you had these TikTok investors. Ooh, I made it rich. You had YouTube investors showing off their gains, all their money they had. And if we go back to this chart of the NASDAQ, November of 2021 was the peak of the market. That was the last time we were below 7% inflation year over year. Kind of crazy to think about. That feels like forever ago, especially if you went from rich to broke like I have. Now, if we get even more analytical and boring, we can kind of zoom into the inflation rate month-over-month figures. What we were just looking at were the year-over-year figures. This is likely to show deflation either tomorrow or when the next CPI data release is, which is, February 14th. Handy, I have the tab open. February 14th or tomorrow, I think we are likely to see deflation month over month, which would be absolutely crazy. We can see over the past 5 months here, bad math, the month over month inflation rate has been very muted. We had a couple of months where it bumped back up to 0.4%, but just recently we were at 0.1%, and I do think tomorrow we might be at 0% or negative inflation month over month. If I'm right, make sure you come back to the video and congratulate me and hit the like button. Even the inflation measure that Powell has been quoted in the past as saying it is the most important to determine what they do with their decision making has been showing inflation tanking even more than this basic CPI data that I've been talking about in this video. Powell's preferred measure is services x food, housing, and energy. By the way, I apologize for the ugly picture. I just saw this graph on CNBC. I thought it looked pretty good, so I put it in the video. In June of 2022, this measure gave us a reading of 12.22% inflation. Now, in this short amount of time since June of 2022, that number is all the way down to 3.17%. which is basically in line with the Fed's target rate for inflation, which happens to be about 2 to 2.5%. And that figure of 3.17% was for November data. There is a very good chance we're going to be at 2 to 2.5% inflation via this measure when we get our data that comes out tomorrow. However, I haven't even got to the biggest deal of this video. The biggest deal here is that Powell and the Fed have accomplished all of this disinflation and even maybe deflation, while the unemployment rate has hit record lows yet again. Talk about a soft landing. The labor market is not feeling this yet. You know, the Fed could do a lot better job making this visually pleasing to the eye, but stick with me, don't get bored. I'll go through this page quickly because I know it's ugly. But total non-farm payroll employment increased by 223,000 jobs in December, and the unemployment rate edged down to 3.5%. 3.5%. That number right there, 3.5%, is tied for the lowest unemployment rate we've seen pre-pandemic since 1969. I said it. Yeah, 1969. And what's also exciting here is that the average hourly earnings for all employees only rose by 9 cents or 0.3%, which was much lower than anticipated. If wages are not growing, consumers and workers will not have enough money to support propped up prices that businesses set, resulting in inflation coming down or staying stagnant. I know, there are so many layoffs in the news. We've seen hundreds of companies, it seems like, do layoffs, but this unemployment rate has not moved. So why would that be? Well, the simple answer is most of those layoffs are coming from tech companies. And we have to remember, during the pandemic, the tech companies had their best years ever. They were in an ultra high growth stage of their business cycle and hence hired so many new workers to help propel their growth. And you know what? I'm sorry, but it's the business cycle eventually that has to come to an end. Eventually, you have to cut off that fat that you put onto your company to grow. That is exactly what's happening here. I, for one, don't know a single blue-collar worker or average American that has taken a pay cut or been fired. It is simply not happening right now. And as long as that is happening, as long as the average American has their job and is not taking pay cuts, spending is going to remain relatively strong, meaning that we are not going to see near the earnings recession that people predicted. Do I think an earnings slowdown is likely? Absolutely. But a lot of people's thesis about the markets for 2023 revolved around this huge earnings recession from people not being able to buy products and services from companies. We're just not going to see that because the average American still has a job, still is making money, and although their savings rates have plummeted, they are still spending money. Their spending is staying very strong. Now, I do realize we have had a very tough Fed that is not backing down from this fight, even though inflation is tanking. They are still saying no rate cuts in 2023. We are still going to raise rates. We still have a lot of work to do. They are saying everything possible underneath the moon in order to remain strict on inflation. And a lot of people think that's going to be negative for the stock markets, and it very well could be. But we have to think about the Fed's position here. Part of their job, one of the biggest parts of their job, is managing inflation expectations, because expectations drive the real rate of inflation. And, if they back down and said rate cuts are going to be coming in 2023, all of a sudden consumers and citizens, their expectations on inflation as a result of that might skyrocket and propel inflation right back up to where it was. The Fed does not want that, so they have to remain strict right now. They simply have to if they want to squash inflation here for good. However, in doing this, if they raise rates a little bit more, if they keep rates flat throughout 2023, that means we've had a strong economy. And if we have a weakening economy, the Fed has enough ammo and firepower in their belt, in their toolbox, whatever your figurative preference is, to cut rates and stimulate the economy and bring us back to where we should be. So there are two scenarios here for 2023. Either we have inflation plummeting and no rate cuts because we have a strong economy, or we have inflation plummeting, a weakening economy, and a Fed that has the tools at their disposal available to stimulate the economy and bring us back to where we need to be. All of those situations are bullish. All of them. So because of how far we really have come down in valuations here over the past year, or however long this bear market's been going, I lose track of time because it's been brutal and I don't want to think about it. But valuations have come down significantly, especially for small cap and mid cap stocks, and large caps also are back in line with what we've seen historically for forward PE ratios. Because we have tanked these valuations so much, I think at least in 2023, we're going to see that 10 to 15% bounce back for the NASDAQ and the 6 to 10% bounce back in the S&P 500 and the Dow Jones Industrial Average. I always could be wrong, but these valuations here on mid caps and small caps in particular simply are not sustainable. Anytime they've gotten to these levels, they have bounced back up relatively quickly, and you can see they've already started to do so. If you made it to the end of the video, I have to say thank you. You must like me, so make sure you subscribe and hit the like button. And also consider joining my membership. We have a heck of a time in there. Lots of really good discussion that goes on. But I hope you guys have a great rest of your day. Stay blessed. 10 toes to the ground. Keep your chin up. This market will bounce back. I already said that. But have a great rest of your day. Seriously. Peace out.